All right. How's everyone doing? This is our, I think, third episode, and we'll be covering 1967 of the Berkshire Hathaway Letters to Shareholders. All
Yep.
right. This is Prabhat. I have Avinash on the other side, and we'll get started. Avinash, you got the stage.
Awesome. So 1967 and 1978 was merged in this week's letters. So let's kind of take a step back and in the previous episodes we didn't cover how Berkshire was doing compared to the S&P 500. That's always a very good comparison to have. So maybe we could start with this, and Prab, if you want to take us through what this is actually saying, and then I'll get to what actually happened in 1968.
All right, let's do it. You want to share your screen just so everybody can see?
Yeah, yeah. Sorry, I thought I was already sharing. Okay, so let's. Okay, let me know if you can see this.
I think it's working.
Okay, so let's start with this.
Perfect. So yes, I mean the same book that we've been using, the Berkshire Hathaway Letter to Shareholders. Like the very first page, it kind of tells you what the relative performances have been, and they use a benchmark of S&P 500, which I think should be the benchmark because at least in today's world, I mean, what is our alternative? I mean, everybody knows index funds are probably the best tool for 99.9% of the people out there. So your opportunity cost of doing and learning about value investing is missing out on the S&P 500 gains. So, and this is what, so I think that is the best benchmark to compare the performance of Berkshire with. Of course, there may be nuances about, maybe the market has become more efficient today compared to, 50 years ago, but that's more of a philosophical discussion. All right,
Mm-hmm.
so we started in 1965. I was going to recap and cover the past 2 years. So we have three columns here. The first column is kind of the per share book value of Berkshire, which you can. I think it may be a way to think about is a good um, surrogate for maybe the intrinsic value. These are numbers not provided by Buffett. Buffett is not giving us these information, but book value is transparent. Anybody can go take a look. Intrinsic value is probably higher than book value, but we will just pretend book value, kind of reflects intrinsic value.
Okay,
And
so
yeah,
a quick question about this book value. So would this be like if you strip down the entire business, then you sold off all the inventory and stuff like that? So in the last few episodes, we know that he had these textile mill, machines. If he sold all that, then uh,
correct.
this is the value
So
that
so
you'd
book
get.
value
Okay.
basically you kill the business. I mean
Uh,
they're no longer functioning. You take over all the cash that they have. They're sitting on a lot of cash, and you pay off all the debt. You sell
mm-hmm.
all the real estate, all the machinery, anything that can be sold, and whatever is left is kind of the equity value, the book value of the company,
Okay.
and this column is generated from just publicly available data. So you're saying in 1965, the book value of the company grew by 23%. I mean, that's remarkable. And in
Mm-hmm.
1966, it grew by another 20%. That's remarkable. And
Mm-hmm.
we'll see in 1967, it grows by 11% further. Now, let's separate that. That's the book, but that's what the business is actually doing. And then now we talk about the market.
Mm-hmm.
The whole thesis of value investing is that markets may not be efficient. There
Mm-hmm.
is, you know, uh, I guess, a separation of what the intrinsic value is and what the Mr. Market is going to offer you for the business. There are going to be differences at times, and that's the arbitrage you take advantage of to make above market gains.
Mm-hmm.
And depending on what's going on in the country, S&P 500 will go up and down, and that's going to be based on people's emotions, their fears, and their greed, and their feelings about the future, and also what the underlying companies are doing. So if the economy is doing well, the companies are very profitable, everybody's happy, the S&P 500 will go up. If there's a recession coming, people are worried about a war or a pandemic, then the future outlook becomes disappointing, and the markets decline. So here we're comparing market price of the S&P 500 and the market price of Berkshire. So 1965, market responded really well to the equity growth, and 40% increase in Berkshire share price, and compared to 10% of S&P 500. I mean, that's great. 1966, market's down 11 or almost 12%, and Berkshire's only down 6.8%. And I mean that tells you, you're seeing less downside and higher upside. I mean, clearly you're doing something different in the market. And in 1967, which we will cover today, S&P 500 is up 31%, and market's only allowing Berkshire to be up 21%, and whereas the book value of Berkshire is still up 11%. The only caveat here, and let's talk about 1968 as well. S&P 500 up 11%. Market is valuing Berkshire 71% higher than the prior year, and the book value goes up by 19%. And you're gonna see, I mean, there's, looking to year is still not gonna be optimal. It's gonna be very lumpy, and ideally you'll see average over 5 to 10 years, and that will hopefully give you a better insight of what's actually going on. The book value and the market value should be similar over longer periods of time, let's say 5 to 10 to 20 years. But year to year, that there may be differences for who knows what reason. Yep. So that's what we're dealing with. Another thing we can talk about is their cost of capital. Berkshire mentioned, Buffett mentioned, he's not thinking that he'll be able to get, he may have expenses coming up, capital expenditure expenses, or possible acquisitions he would like to make, purchase businesses in private markets that he needs to have cash for, and how, I mean, one way to do it is to borrow money, and how expensive the loan will be is kind of depends on what the American Fed has set the interest rate. That affects that whole the cost of capital issue. Currently, the loans are cheap because the interest rates are low, but interest rate used to be much higher in the past, and borrowing was not as easy. So I have I'm looking at this page. I think it's the Social Security, the agency that provides Social Security has can provide the rates. I mean, I think they're correlated. I don't know if these are the appropriate rates, but they should be correlated to what the Fed interest rates were. In 1965, you see about 4%. 1966, you will see about 4 to 5%. 1967, again, 4 to 5%. So that's kind of the interest rate of that time. Today, the interest rates are about 1%. So and Buffett likes to think. I mean, Buffett's baseline is he assumes interest rates are going to be about 6%, 5 to 6%. So he could. I mean, I think these interest rates are still not that crazy expensive. Most student loans are 6%, 6 to 7%. So, but he may not have a good collateral either if he wants to borrow a lot of money. He's looking for big sums of money, and Buffett doesn't necessarily want to get rich quickly. I mean, he fundamentally would like to avoid debt if he can. Though he's smart and I don't know what he thinks, but and he does borrow money when he thinks it's right, but.
Mm-hmm.
But when he's not sure about a deal, I think he would like to avoid borrowing because he has seen a lot of respected people fail because of leverage or
Yep.
borrowing money to commission acquisitions or trying to get rich quick.
Mm-hmm.
So he to me sounds like the bottom line is to me sounds like the cost of capital isn't terrible around that time during those years, but he may just be cautious. He wants to protect his downside.
Mm-hmm. Yep.
So that's my best guess.
Okay. And we should also point out, so just a couple of notes from the first few pages when we saw this in the book. These aren't. Do you want to just quickly mention this, Prab? Or
Sure, yeah. I mean, there's a small caveat here in favor of Berkshire. Actually, Berkshire earning Berkshire returns compared to S&P are slightly understated. I mean, they're a little bit actually higher than they would be because Berkshire returns are listed after tax on an after tax basis because the corporation has a fixed tax system. I mean, they paid tax that they pay. There's no confusion about that. Where in S&P numbers are frequently reported as pre-tax because I mean, these are other than the dividends. I mean, a lot of this depends on who is the investor. Because I mean, my tax rates may be different compared to somebody else, depending on income levels, how they're buying and selling. So it would not be appropriate to say S&P 500 returns as a pre-tax basis. So that's a small caveat.
Yeah, but it's a pretty good comparison.
It is a good comparison.
I think the closest that we'll get to an apples to apples comparison, I think.
I agree. I mean, you could say, let's just do the pre-tax returns of Berkshire, but I mean, I don't think you're gonna get a lot of value from that is gonna move things few percentage points, and you're gonna missing the big picture for a smaller technicality.
Yeah. Maybe we could quickly, maybe let me stop sharing. So maybe we could quickly recap what happened the last couple of years. So where did we last leave it off? And then I'll get to the situation that we're in 1967 and 68.
I mean, I doubt there was big changes, but what I remember, there was Vietnam War.
Yeah.
China is kind of going through a revolution of sorts.
Yeah.
And I mean, of course, we're in the space race still. The 60s. People are, I think, kind of rosy and they feel good about the future. I think overall, there's no big reason other than the Cold War, which was a multi-decade thing.
Yeah.
I think people are kind of hopeful about the future of technology and what the future has to bring to their lives.
Yeah, and what about Buffett? Like, what's he doing at this stage? So he's kind of
Buffett is in his mid-30s still.
Yep.
He's still living in Omaha, I believe. Still, I don't think he. I think he is corresponding with Charlie Munger. They're friends. They are not business partners, but they're friends and collaborators. And I think he has ownership stake in Berkshire. I think he still has his partnership, his personal partnership. I don't think that has been dissolved yet. But I think and he's still married. He probably has kids. I mean, he's mid-30s. He got married when he was 21. So he's a family man.
Yeah, but I mean, in terms of his business, I guess it's not doing too well right now because he had to lay off a lot of people and he had to dissolve a few factories. And he's probably thinking to himself, "Man, I gotta either get out of this business or look somewhere else for my investments."
Yeah, absolutely. And, as far as Berkshire is concerned, yes,
right.
He's. I think he's coming to coming to terms with the fact that Berkshire is a cyclical business with a high technological competition that's requiring him to make all these investments. It's
Yep.
unpredictable. He doesn't know, what the new trend will be, what
Yeah.
the new fashion will be,
Yeah.
and when he'll have to buy a new machine, when it'll become obsolete.
Yeah.
So I think he's started to look for other ways to make money using Berkshire. He's looking for
Right.
other business opportunities besides just textile mills. And he has
Yeah.
a majority ownership of Berkshire, so he has a controlling stake, and he can decide where the earnings will be, how the earnings will be used. So,
Yep.
so-
Yep, that's right. Okay, so let's kind of jump into what's going on in 1967 and 1968. So this is so this letter combined both of them. That's why I'm kind of showing both here. So Buffett now is 37, 38, 67, 68, and so the stuff that's ongoing. Just to recap everyone's memory. So we have the Cold War. The decade is about the space race as well, the Vietnam War as well, but particularly 1967 and 1968. So this is his third and fourth year, so kind of the last years of Lyndon B. Johnson. And then on January, Chicago has its largest blizzard ever. So pretty cold, literally. So February 7th, the Chinese government. So remember how last week we talked about China, how they're kind of going through this cultural revolution. So February 7th, the Chinese government announces that it can no longer guarantee the safety of Soviet diplomats outside the Soviet embassy building. So while the Soviets were still in China, so February 15th, the Soviet Union announces that it has sent troops near the Chinese border, so there might be some kind of beef there. But, last week we covered this thing about Red Guards, and so I found out that the Red Guards was actually this mass student-led movement that was guided by Mao Zedong in 1966 through 1967. So this was the first phase of the cultural Chinese Revolution. So that's kind of the place that we're at. And this immediately made me think about Leila, because he was part of that cultural revolution as a student, but he was just born in 1966. So
I can't believe we missed that for last year. That's beautiful.
I know, cannot believe we missed that. I was beating myself up last time as well. I was like, oh my goodness. And then Paprai was born a couple of years before that, so 1964.
Paprai is older than Leila?
Yeah, I didn't know that. It's kind of caught me by surprise as well. But interestingly, these prominent kind of investors that we think about today, Leila got really involved with the Cultural Revolution later on, but these guys, these guys are like just born when Buffett is 37, 38, and they're going to be pretty much students of Buffett. So it's pretty interesting to note. There's 30 years of repository that they're going to be, when they're just starting off as kind of kiddos and babies. So I thought that was interesting. So, remember, we still have the Vietnam War that's going. So on March 21st, Howard University students protested the Vietnam War. They were saying America is the black man's battleground. So think about all the kind of cultural revolution, you could say, that's going on in America as well with African American rights. So that we're in the midst of that. And March 31st, Lyndon B. Johnson, the guy who's president right now, he's no longer going to be seeking re-election. And who came after Lyndon B. Johnson, by the way? You want to take a guess?
I don't know. Is it the Hollywood dude, Reagan?
No, it's Nixon.
Nixon? Oh, Nixon.
Yeah, Nixon.
I'm
Nixon
terrible at this.
Me too. April 9th, the first Boeing 737 takes mid-flight. April 3rd. So this is the beautiful Martin Luther King I've been to the mountaintop speech. And of course, April 4th, the day after that, he gets assassinated. So he's shot dead in Memphis, Tennessee. And of course, this causes huge riots to come up. And, these will last for several days after this April 3rd kind of scene. So May 1st, Elvis gets married. So kind of pop culture wise, we're seeing, Jimi Hendrix also May 12th. He releases his album Are You Experience? So culturally, you have two kind of the greats, Jimi Hendrix and Elvis, kind of having some episodal kind of movements. So, interestingly, you would think that China would be way back when, right? So you wouldn't think that they'd be that technologically advanced because they're still coming up. But they tested their first hydrogen bomb June 7th. So, yeah. Now coming to 1968, again, the same things are kind of going on in that decade. October 18th, 1968. Now we have Walt Disney's 19th full animated feater
and he's already released. Dead, right?
That's right. So this was the last one that he worked on, and now it's released in 1968. And then November 27th, the Beatles released their major tour and their U.S. album. All these great classics: Penny Lane, Strawberry Fields Forever. All these guys, Hello Goodbye. All these just released November 27th, 1968. Richard Nixon is elected president, so no more Lyndon B. Johnson. And kind of famous people born in that 1967 era, so A.R. Rahman, R. Kelly, John Ive, Tim McGraw, Anderson Cooper, Nicole Kidman, Will Ferrell. I can't believe these guys were born, Jimmy Kimmel, Joe Rogan, Julia Roberts, all these guys born in
James
1967.
Bond,
yeah.
Will Smith, Hugh Jackman.
Yeah, that was 1968. I was so surprised we actually know some of these folks who, were prominent now. Of course, they were just born at the time. But
I want to mention one more thing about that era.
Yeah.
So go back to Asia.
Yes.
Singapore was this kind of a swampy place. Didn't have much going on in terms of economic value. And tried to kind of merge, kind of like a European Union type thing. Kind of tried to get back with Malaysia, which is its neighboring country.
Yeah.
And they were basically in 1965 kind of kicked out of Malaysia because they didn't want to, they still wanted to value individual rights in terms of letting people have right to their religions and not necessarily forcing people to give up that much autonomy.
Mm-hmm.
So and Lee Kuan Yew, who's
and Lee Kuan Yew is the prime minister at the moment?
He has been the prime minister for about a decade now. He was prime minister when it was independent, and then he had kind of spearheaded the merger back into kind of Malaysia, where Singapore still had autonomy, but they shared a lot of resources, I think, with Malaysia. And 1965 is when Malaysia was like, this is too much, it's not worth it, you guys are on your own, and Lee Kuan Yew will continue to be the prime minister. But Lee Kuan Yew is kind of really desperate of trying to figure out what he's going to do with this country during these years.
Yep. And we should point out, for those who don't know, a little bit of a tidbit for all the Munger fans out there. The only bust that Munger has on his table, actually there might be two, but do you know who they are?
Well, I definitely know. I mean, he has said in the interview that he has a bust of Lee Kuan Yew, hence we were talking about this. Other one might actually be Benjamin Franklin, because he loves Benjamin Franklin.
Yes, he loves. That's the two that I was thinking about. Man, we need to get out more. This is insane. That's insane that we know that.
It is fun.
But that's a really good point. So I guess Lee Kuan Yew is around this time. He's getting out of Malaysia. Is Singapore still a swampland right now? So it's a malaria infested place.
I mean, so I think Singapore used to have a lot of. I think it used to be a port back in the day, like a few centuries ago, but I think it always kind of lawless kind of thing where people would just congregate it and do what you need to. I think even I think some of the Pirates of the Caribbean have had scenes in Singapore, if I'm not mistaken.
Oh, interesting. Okay.
But I think it was never organized. It was never a country. It was kind of lawless, swampy state. And Lee Kuan Yew had. He was born kind of around Buffett time frame, and he became prime minister of Singapore in 1959.
So so he's been in the game for quite a bit now. Okay.
Correct. And at that point, I think that's when Singapore had kind of no, I think it was part of Malaysia from 63 to 65. And then in 65 it was kind of kicked back out, and since then it has remained independent. And he was prime minister then till 1990s, at which point he started to kind of take more of then after 1990 he started to back off a little bit. He stepped down as prime minister, became senior minister, and then I think he passes away in like 2015, I think.
Yep.
But
yeah, huge shout out to Lee Kuan Yew. I'm sure he's a great read if anyone's interested.
He's struggling right now. Yes. Great read. I agree.
Yeah. So that's kind of what's going on. We could jump into the letter for 1968.
67. The year 1967. The letter was written in March 1968.
Okay, gotcha. I'm ready when you are.
All right, just remember Berkshire, sitting on a lot of working capital, a lot of cash, so he can, pounce on the next opportunity.
Yeah, and also Buffett is thinking about exiting and kind of putting his money in other areas.
I don't know if he wants to exit. I think he's just trying to expand.
Fine. Okay, that's fair. Yeah, different ways of making money.
Diversify.
Not just with the textile.
Yeah, I think from his point of view, he can only go up. I think he got into a terrible business because of an emotional decision, and he's trying to. I mean, he's still pretty cool. I mean, sounds like I don't know if he's depressed. I would be like, question everything, and from his letter, just seems like, he just doesn't care. This is all a game to him. It's like, okay, like it's like playing Monopoly.
Yeah, and I have to say, like Buffett, I think in an interview he said he hated doing this because he had to fire a lot of people, and he hated doing that, and closing down plants and stuff like that. So even personally, I'd say he's kind of in a turmoil. He's like, I just wanted to make money. Why are people getting hurt?
Later on in hindsight, he said he should have never done Berkshire deal, and if he did, he should have put an end to it a long time ago. Yeah, but I think this goes for 15 more years.
Yep. Okay, let's do it.
All right. So here we go. The company has adopted a calendar year for accounting purposes. This new calendar year and substitutes for the previous September 30 year end. The change was effective December 30th, 1967. This report covers the 15 months ended December 30, 1967. To summarize that, he just simplifies his accounting. Previously, Berkshire had this tradition of they were measuring their performance and financial statements from September to September, from year to year. And he's like, okay, I don't like this. Let's just keep it simple, January to December. Sometimes companies will make changes like this for just to kind of cover up their accounting and to play, tricks. But I've been knowing Buffett now, I think he's just trying to, simplify things that could be simplified.
Yeah, interesting.
Textile operations. Fiscal year ended September 30, 1967. And then this is the first time he's kind of made it so there's going to be some overlap of preceding 12 months or the 15 months, from December 67. So, but I think that's nuance. We don't have to necessarily dig into it. Okay, so fiscal year that ended in September 30th, 1967, in type of sales. Total sales showed a decline from 50 million in fiscal 1966 to 40 million in fiscal 1967. The cause of the drop in dollar volume was a combination of a decrease in yardage demand in all divisions and a sharp drop in prices in all areas except the home fabrics division. So a huge drop in demand, it sounds like, except for home fabrics. Yeah. Although sales and profits of our home fabrics division were down substantially, this area demonstrated the greatest resistance to the depressed conditions of textile markets in which we operate. Berkshire Hathaway does not produce coarse goods such as heavy ducts, which is a segment of the textile business that was the strongest in 1967. So to kind of summarize, uh, everything is down in the textile industry,
Yep.
including home fabrics. But home
Yep.
fabrics was still the most profitable of all the textile divisions for Berkshire.
Mhm.
There's another segment of the industry that did great, but they don't really participate in it because that's
Mhm.
more unrefined. I think that's even more of a commodity thing.
Yeah.
Sounds like coarse goods.
Yeah. What the heck is heavy ducts?
I don't know. Maybe.
Okay.
I'm kind of curious. I was like, I doubt it has anything to do with ducks.
No, but that's where my head went. I was like, oh my god, is this what Buffett does in his spare time?
Coarse ducks in textile? I don't know. I'm actively Googling this. I think it's just type of a fabric.
Oh, okay.
And I think that's all I'm going to have to say about it. It's
Yeah.
type of
Okay.
a fabric.
Okay.
During the year, we curtailed our production about 15% in an attempt to avoid building inventories. So they're cutting back how much they produce because they're worried about a downturn in the cycle and they don't want to necessarily produce things they can't sell and you know, resulting in waste.
Mm.
We maintained satisfactory inventory levels, but our curtail resulted in the loss of certain categories of skilled help, which will be required if we are to fully utilize our planned capacity. Therefore, abnormally high training costs will be incurred before we again run full. So they have fired some people, and because of the downturn, and they're telling you, the shareholder, that if the market does great again and they need to, ramp up production, they will have to hire new people and they'll have to, spend money to train them. So that will be a cost in the future. The other option is not firing anybody, keeping them on the payroll and hoping that the economy turns around. And he didn't want to do that because he doesn't know what's going to happen.
Mm-hmm.
By the end of the fiscal year, there was some indication that the general textile market was improving, with the exception of that for our fine combed lawns, which we manufacture at our King Philip D division in Warren, Rhode Island. Man, this King Philip, I'm starting to hate this whole division.
Yep.
This fabric remained in poor demand with depressed prices throughout the year. A market survey indicated that the demand for cotton lawn fabrics was gradually being displaced by a demand for polyester blend fabrics. So again, you see, maybe the industry and the consumer taste is shifting and causing uncertainty. On the positive side, we expanded our home fabrics product line into a wider variety of fabrics and also expanded our sales force in this area. In addition to this, we started an apparel fabrics division selling finished yarn-dyed boxed loom goods into the women's apparel market. Both of these moves were a part of our general policy of attempting to establish product lines away from areas of direct competition with staple fabric producers. We intend to further implement this policy. Mm-hmm. So he's seeing what's working. He's trying to water his flowers so they will grow, and he's trying to innovate out of this competition industry. I think where people just, instead of maybe being a producer of large fabric that would be used to produce maybe dresses. I think he's trying to produce more of a finished product, hoping he can enter a niche market where he can dominate and there'll be less competition.
Yeah. So really, he's trying to carve out a small niche area where there isn't that much competition. So all these other areas where he's like, oh man, I'm getting killed out here. Everyone's, I want to find a little small niche and then just grow that, or maybe just make that the most part of the business, or maybe the profitable part of the business. Yeah, which is a great takeaway for entrepreneurs, actually, if you think about it. If you try and do what the other most popular thing is doing, then you're probably not going to succeed because you need a niche to start off with, and then you can grow into something.
It's ultimately about competition. If you have a lot of competition, capitalism is brutal. Why should you exist and succeed when other person can possibly do it for cheaper?
Yep.
And all right, next segment of this letter: manufacturing operation. Because of reduced levels of production, smaller individual orders, and more frequent loom shifts, manufacturing costs were materially higher than in the last several years. Our return to full operation should correct this situation to a great extent. Although product development and diversification of fabrics will result in higher manufacturing costs, these higher costs should be more than offset by higher prices for the fabrics and result in greater profits. Okay, to summarize that section, he is noticing we have cut down, the market is kind of reduced a little bit, and I think he's kind of lost some of the benefits of somewhat of a scale. So things he's producing, he's not producing a lot. I mean, machines are fixed assets. The machine is there, whether you use it or not. So I think per sellable item, his costs are higher compared to prior years. So his manufacturing costs are higher.
Yep.
And he's saying as we use our operations to full scale in the future, that should normalize to a lower cost. It's a temporary thing. We are mindful of it, but we're not over dwelling on it. And he's also he's already thinking about creating a moat. He's trying to do this product development and diversification into these areas where he can have higher manufacturing costs. He wants to increase his prices and recoup, have higher profits, basically.
Yep.
All right. Labor relations remain satisfactory. Our labor contract will carry us through until April of 1969. A general wage rate increase is called by this contract in April of 1968. The current labor market is a difficult one, as for most industries, with relatively fewer job applications being received from persons possessing the requisite training and skills.
Interesting.
So he doesn't have people to work. He's not getting applications. People that he does have working for him wants more higher income. So he has had this contract in place where they will have increase in wages. So he's kind of trying to deal with these demands of the labor, and that's another cost.
Yep. So it's going to cut down again on his business because he'll have to pay more of these guys.
Correct. And now he covers the 3 months at the end of 1967, and that's the accounting change he has made. This quarter showed a very definitive increase in demand in all divisions except King Philip D. We operated at close to normal levels, with some equipment idle only because of our inability to quickly obtain and train sufficient people. Our new apparel fabrics division was off to a good start, and our home fabrics division renewed a historical strong growth pattern. Based on current market conditions, we expect a significant improvement in textile operating profits during 1968. Our operating loss carry forward has been fully utilized, and any future net profit we realize will be subject to normal federal income taxes. To summarize that paragraph, it looks like things are already turning around since 3 months ago. He's hired more people, there's good demand, and things look profitable enough that he's kind of everything went forward. He will be paying income tax on. And still in King Philip D division is kind of lagging behind. And I have a feeling maybe he'll soon just cut it off and invest into the growing areas. All right. Next paragraph. The portion of our business which proved unsatisfactory was the cotton lawn business. As a result of a second market survey, it was decided to close the King Philip D division in Warren, Rhode Island, where these goods were manufactured. The plant was an efficient one for the manufacture of fine-combed lawns, which unfortunately are no longer in any sort of demand. The equipment at this plant had little adaptability to other end products, thereby making a conversion attempt uneconomical. The decision to terminate operation was hastened by the very large increase in the cost of new crop cotton, which could not be reflected in increased finished product prices. Any loss from termination of operations at King Philip D will be reflected as incurred in 1968. At this point in time, we can only speculate as to the amount of this loss, but we do not envision that it will exceed $1 million pre-tax. Wow. Okay, so a couple things. He's killed King Philip D, which made a cotton-based product, and there was two new problems with this kind of a product. Terrible demand and incredibly high cost because increased cotton costs from the suppliers. And if you recall, some of the other products were, I think, polyester based, which is not cotton, which is, I think comes from petroleum products, polyester. And so they just cut it off, and there are going to be some losses that, is going to, because of the accounting, and they're going to include it in the next year. So we'll see how much losses they come. But,
and he wasn't too happy with this King Philip D division even in the past few years, right? They
Correct.
weren't doing.
It's always lagging behind, and then I think they had multiple divisions of this King Philip, and I think one of them, they also turned into just storage. And he's saying the equipment is also, you can't really use it for anything else.
Yeah.
So I mean, only thing to do is maybe sell it or just get rid of it. I mean, selling is probably better, but I don't know how much demand there will be in the industry. Because if he's having trouble in this industry, probably everybody else is also.
And also, one kind of takeaway that I got from this was that you have to be kind of aware of raw material prices. So, if cotton price went up and then, your whole business is dependent on it, then, if you don't have either multiple OEMs or maybe different manufacturers, then you're probably...
Correct.
Yeah.
And I don't know what the source is there of this cotton. I don't know if it's actually America still making cotton, or it's still this international market where they're still getting their cotton from, maybe Egypt or some of the other countries.
I would think America, but not sure. Yeah.
Okay. But it doesn't matter. I mean, it's these kind of problems probably happen in any business. I mean, we're seeing that now, right? In with the pandemic, supply chains and the cost of semiconductors have gone up, and it's affecting, car manufacturers' bottom line. They can't produce, even though they have high demand. They still can't put out a product.
Yeah.
All right. Now, it's gonna be an interesting section next one, titled "Insurance Subsidiaries." All right. We are highly pleased with the results of our insurance subsidiaries since their acquisition in March 1967. So it sounds like about 9 months ago, they bought these companies. These two companies, National Indemnity Company and National Fire and Marine Insurance Company, continue under the very able management of Mr. Jack Ringwald, who has guided them since inception. So this is original management. Gross premium volume increased only slightly during 1967, but termination of certain reinsurance arrangements resulted in a substantial gain in net premium volume. The underwriting was conducted at a good profit margin, and the investment income increased substantially, reflecting both a greater base of assets and higher yield that prevailed throughout the year in fixed income sector. All earnings of insurance subsidiaries are being retained to build additional capital strength. Beautiful.
I love that. So let's talk about maybe why. Okay, I mean, of course, insurance is going to play such a big role in this, so we're both kind of excited here. But why do you think he saw insurance as a good thing to invest in? Maybe we'll start there and then we'll go into.
Okay, so this is not as he has already learned about insurance, and I think he already owns part of Geico.
Yep.
And this happened because Graham.
Yes.
Buffett loved Graham. He followed him, or I think he went to New York to work for him.
Yep.
And then he was obsessed. So he started cloning him. Graham owned Geico, and Buffett was like, I'm gonna buy Geico, and he
Yeah.
went to visit, I think, the Geico office, and some dude, I don't know what his role at the company was, I think just randomly had a 4 hour conversation with Buffett about how insurance works, so he
Yeah.
understood what insurance
Yeah.
did in, I think, in his early 20s. Now he's in
Yeah.
his mid 30s. So
Yeah.
he knows insurance, he understands insurance, he owns insurance, and hence the first acquisition he makes with his retained earnings from the textile company is not one but two insurance companies.
Two insurance companies.
And I
Yeah.
think he bought them outright. I mean, he bought them on the private market. These are not public companies, I think.
Mm.
And
Very
so,
interesting.
and in this paragraph, he says, so these have pricing power. He increased, well, looks like the volume uh, of his premiums increased. That means, I think he got more customers, and he terminated some of the contracts that were not adequately priced. So he cut out some unprofitable deals, or customers that the
Yep.
business had previously made. And he, like, the underwriting. I mean, that's how you decide what your risk is and how to price that risk and how to make a profit on that difference. I mean, he felt that underwriting was done well and he had good profit margins. That's probably why he bought it. Otherwise, he wouldn't have even bought the companies.
Mm-hmm.
And their investment income increased substantially. And he said, you know what? I'm keeping all this money. I own Berkshire. Berkshire it's not gonna go as part of the dividends. This is separate. We will do what we just did. Hopefully, invest in, and this is the actual parts of Berkshire.
Yeah.
This is
And
yeah.
what I mean, just to what is underwriting here? Is that just looking at the books and then
Underwriting
finding out that it's good?
is what is how you run an insurance company. Insurance company is, and to summarize, you're trying to protect yourself against uncertainty. So I'm gonna go into a little bit of philosophical and what finance is about. I mean, there's chance in this world,
Mm-hmm.
and chance is unpredictable. Kind of goes to black swans. I mean, there can be random events that happen that you don't have control over. It can change your life drastically and unsuspectedly. It can be good, it can be bad. These kind of random events, if they're good, great. You don't need to insurance against a good thing that happens out of chance. You're walking down the street, you pick up a lottery ticket, it's a winning lottery. Great. You don't need to pay someone to protect you against riches.
Yep.
But there can be negatives. Like you're walking down the street, on your construction site, something drops on you, and now you're dead, or you're disabled. Random thing. Or you're driving a car, in a car accident, you're out of a job because you're hurt. Random bad thing that happened. So these are unpredictable on an individual level, but when you pool these risks, they are somewhat predictable. You kind of know how many car accidents happened this year, last year, the year prior. You can kind of estimate how many will happen next year. You don't know who will get in a car accident, but you can guess how many will. So so if you insure a population, you kind of know what expenses you should incur in the following year.
Okay.
And you just charge premiums, and at the end you should make a profit because your expenses should be somewhat predictable. You have some margin, and you may have one bad year, but overall, over a 10-year period, you should be in a profit.
Okay.
So, and that's what underwriting is: trying to put a number on what the risk is, which is what your cost will be. And trying to figure out how much you're going to charge your customers.
Yep.
And how much your competitors are charging your customers, because you don't want to charge them high enough that they don't come to you, but you also don't want to charge them low enough that if something does happen, you're broken out of a business and you're bankruptcy.
Yep.
So that's the art of underwriting.
So that's okay. And we know Ajit Jain is kind of the genius at this later on in Berkshire, but so Buffett has a pretty good handle on this. So I guess if you were to seep into his mind, it would be that he could predict that this is how many injuries or whatever it is that he's insuring, or fires or whatever it is. So he can kind of predict that. But the good thing about the insurance thing is that it's super cash heavy. So you get a lot of money that you get to play with, because hopefully that these occurrences don't happen. And now he has all this money to play with. And now he says, hey, look, now with all this money that I have, I can invest it in different ways.
So it's free financing, right? And we both recently learned, how, Amazon has the same model, right? They get cash flow first. They get money from us first, then they pay their suppliers. Berkshire, through insurance, gets money through the premiums first, and months, years later, they have to pay for whatever happened. Apple, it's the same thing. You pay Apple first, and then months, years later, they pay Foxconn when you have, when you have paid the Apple and you got your device, and now supplier is the last one to get paid. And this is a theme of free financing. I mean, where you don't need external capital. You can just grow for free. I mean, talk about poetry. I mean, this is why America is great. I mean, so many incredible businesses have free financing here.
Yeah,
it's magical.
Yeah, incredible.
I think Pabrai also tried to do it, and then he got, he tried to do the workman's comp area, and then I think he may have sold that insurance company already, from what I understand, but I'm not sure. Okay, next paragraph. That was just one paragraph. Beautiful.
Beautiful. I love that we're getting into the insurance aspect of it, because I never understood that business, but I'm so glad I get to delve into it with you.
Yeah. Our investment in the insurance companies reflects a first major step in our efforts to achieve a more diversified base of earning power. The success of this effort is indicated by the attainment of earnings in the subsidiaries during 1967, which substantially exceeded the earnings attributable to a larger capital investment in the textile business. Okay, what does that mean? They just bought this company.
Right.
And they also invested a sum of money into the textile business.
Yeah.
And it's saying the money they just invested in the insurance business has given them more cash than the new investment they made in the textile business. Yeah. I mean, he's not saying the insurance business is already more profitable than the entirety of the textile business, but dollar to dollar, everything he spends on the insurance business, he's getting more out of it than he's spending in those CapExes and product development as part of the textile business.
Yeah, and he's hinting to the shareholders, hey, look, guys, the insurance business seems like it's doing better than
this
boat, textile business.
This ship is about to take a turn, go in a different direction. Sounds like.
Just pre-warnings. Yeah. Love it.
We expect there will be years in the future when the order of relative profitability is reversed, reflecting different stages in both the insurance and textile cycles. So here's hinting there'll be years that the two industries will be uncorrelated. That textile might be up and insurance might be down, or insurance profits might be up and textiles might be down. As a result, you're getting more steady cash flow. So I mean, this is diversification done right, where you have two assets that are uncorrelated on different cycles, and as a result, you're doing much better.
Yep. And it's not inversely related either. So it's not like insurance goes up and then the textile business goes down.
I mean, there's no correlation. If there was strict inverse, then that may be good. I don't know about much of the finance theory and academia and that, what the correlation has to be for optimal performance. But I mean, they're not well correlated.
Related
That's
at
what
all.
he's saying.
Yep.
So he's saying this is good. However, we believe it is an added factor of strength to have these two unrelated sources of earnings rather than to be solely exposed to the conditions of one industry, as heretofore. I don't know what that means. So clearly, I mean, kind of what we said. So
Right.
all right, last paragraph. Future objectives. Management continues to be alert to opportunities to expand our operations in either the textile business, the insurance business, or unrelated area. We feel it is essential that we not repeat the history of the 1956 to 1966 period, so preceding 10 years, where overall earnings on average invested capital of over $30 million were something less than zero. So what he said that in the past 10 years, the $30 million that were invested in Berkshire, the earnings were kind of zero from that. So you didn't really get anything out of it. Might as well not have invested that money.
Yep.
Our present liquid resources held in readily marketable common stocks are available for either acquisition of new business or for application towards greater profit opportunities in our present operations. So he still has those liquid stocks that he can sell once he finds something. Interestingly, he's not sitting in cash.
Yep.
He's invested in stocks that he can liquidate when he finds something. In addition, we will not hesitate to borrow money to take advantage of attractive opportunities. Here, I mean, he said, I will borrow if I need to.
Right.
So
but he's saying he won't hesitate to borrow. But would this mean borrow from like big banks here, or are we talking about like from cash reserves from the insurance companies? I'll use that.
That's not borrowing. I think borrowing means from external source,
Makes sense.
bank or whoever will lend you money for cheap.
Okay. Interesting. And the insurance rate, you said, I mean, the interest rate was around 4%, you said?
4 or 5%.
Okay, interesting. Okay.
Our goal is to obtain a reasonably stable and substantial level of earning power commensurate with the high capital employed in the business. So he's saying, I want to have a stable and substantial level of earning. So he wants to have stable and high percentage of return on the money he's putting in to the business.
Yeah.
I mean, that's the definition of a good business.
Yeah.
And that's how he ends it.
Incredible. One thing that I did want to kind of get your thoughts on is, so it seems like he's pivoting. Am I wrong here? So he's an entrepreneur. He's a solopreneur, kind of, if you think about it. He just has some family investments at this time that he's grown. He's been in the textile game for about 10 years now. And then he's saying, hey, man, this textile stuff's not working out. Maybe I need to pivot my business into something else. Am I reading that wrong?
I think that's... there's a higher chance that was his thinking. But I don't know why this is not his first rodeo. I mean, he has invested in multiple businesses, presumably special situations in his in his 20s. And he knows how a lot of businesses work and what is profitable.
Yep.
I think, and he's independently wealthy at this point, so he's trying to figure out how to make a lot more money and maybe do other fun things like run a business.
Yeah, and also I guess it's unfair to say that he's been in the textile business for 10 years because it's like he just came into it because of that guy that Seabrick or whatever his name was. He wanted to kick him out, and then now he's in charge of it.
This was going to be a net situation for him. He bought it because he thought it was cheap and to make money on it. That's how he invests. I mean, he's never. It was not gonna be a long-term hold.
That's right.
And not because of that emotional decision. Not only is it a long-term hold, but he's kind of ending up managing it. He never wanted to manage a business. I don't know how much he's managing, but sounds like he's keeping up with, a lot of what's happening.
Yeah, I mean, he's got his feet wet for sure. Now he's writing these letters to the shareholders. He's talking about the business, so he's for sure super involved in the business. And I guess it's super un-Buffett-like. What he wants to do is give money, take a step back, do nothing.
But he doesn't want operation. He wants capital allocation. That's what's his interest. And he may be reading this wrong. Maybe he's not really managing it. Maybe the Chase family is doing all the running. But yeah, the only other time I can think of where he actually runs a business is Salomon Brothers in the later 90s
Mm-hmm.
or
Mm-hmm.
mid 90s or
Yeah.
early 90s. But yeah, I mean, I think I wouldn't be surprised if he doesn't actually make, day-to-day decision. He's kind of
Yeah.
just talking to them, and he spends 99% of his time still studying companies and trying to figure out what to buy.
Yep.
He may just be
Yep.
doing that part. And these letters are written by Buffett, signed
Yeah.
by the presidents and the Chase family. But
Yeah.
I mean, he clearly has incredible. Maybe high level view of what's happening with the business because he does own majority stakes. So if I had a majority stake in the business, I would also keep up with, where the money is going.
Yeah.
But yes, I mean, now this is an incredibly exciting year. He's bought these two companies that I kind of wish he would go more in detail about what these businesses are. What is National Indemnity Company and the Fire Insurance Marine Company? Why did he buy these? He doesn't go into that. That's okay. That's really
But we know he's in the insurance game now.
Yes.
That's all we know.
And he kind of tells us why he's in that game and what his
Right.
direction is. I mean, he's shared
Yep.
a lot.
Yep.
All right.
So this is great, man.
This was great.
This is awesome.
All right. Let me. Yes. We'll
See
now move to
you
1968 next.
Yeah.
And okay.
So 1967 and 68 we kind of covered. So
Well, this
next
was
would
1967. This was 1967. From basically September 1966 till December 1967.
December.
And now
Okay.
we'll do January to December 1968 next. The letter of that is written in March 69, I think. That is
69.
But
Right.
the years will be January to December 1968.
Okay.
All right.
Awesome.
All right.
Excited.